Hi, good evening everyone. I'm Komal Tyagi from Team Taxmann and I welcome you all in today's live session, Most Favored Nation Clause in Tax Treaties, Identifying Opportunities. I would like to start with a brief about Taxmann. We are the leading publishers on tax and corporate laws in India. We maintain the largest and the most accurate online database on income tax, international taxation, GST, company and SEBI laws, IBC, FEMA banking and NBFC, competition law, accounts and audit, and Indian acts and rules. Over the years, we have worked strenuously to offer the solutions that will continue to help you grow your practice. Our 6 decades of experience in the domain has helped us to constantly innovate and enhance our services and take the tax practice to a newer height. We have also developed the national website of the Income Tax Department and we maintain it with the help of our tech team and editorial. I welcome our learned speaker, Mr. Gaurav Singhal. He is an experience of 19 plus years, specializing in corporate and international taxation. Sir has worked for more than a decade with the BMR Associates, KPMG, and Ernst Young. He is a co-founder of Saksham Ventures, a knowledge enterprise, and heads up consulting, a professional services firm. He has been nominated as a special invitee of the Committee on International Taxation of the ICAI for 2021-22. He is a regular speaker in multiple seminars organized by forums such as ICAI, IFA, PhD chambers, etc. He is frequently invited by public sector companies, law firms, accounting firms, and other enterprises to train their employees on recent domestic and international taxation developments. Thank you, sir. It's an honor to have you with us. Now, before we proceed, here are few tips for our audience also. Firstly, your mic will be on mute. However, you may post your queries in the chat box given on your right hand side. Your questions will be answered by the speaker during the session or after the session by the R&D team. Further, a copy of this presentation shall also be sent to you in email for your future references. Now, without taking much time, I request Mr. Gaurav Singhal to address our audience and proceed. Thank you so much, sir. Over to you.
Thank you so much. Hi, everyone. Today we will talk about, a jargon, an expression that we all find ourselves in love with whenever we are talking in the context of international taxation. We will talk about the most favored nation clause. Today's discussion will actually proceed something like this. We'll first read verbatim what a most favored nation clause reads like. The reason why I'm reading this clause verbatim is because I want to put before you that how at times long-winded expressions, sentences lead us confused, which is the reason why most favored nation clause tends to be a bit intimidating for the ones who are just beginning with the international tax practice. But then, of course, that's my job, that I will make it easier for you to understand by way of an illustration. That's where we'll understand the meaning of the MFN clause. And from there, we'll take off and we'll understand how MFN clause creates opportunities for us. What was the origin, how it applies, where do you find the MFN clause in the treaties, or the types of MFN clause in different treaties, because lots of treaties which have MFN clause, not all of them have them, mind you, have MFN clause in different shades of variation. So we'll talk about that. We'll look at the most common application of MFN clause in the context of royalty, FTS, and dividend. And then, of course, we will talk about some of the most intricate controversies which are running around the most favored nations clause, MFN clause. First of all, the verbatim reading. What you're looking at right now is actually one of the simplest MFN clause. We will look at more advanced versions of MFN clauses, but this is a very, very plain and simple MFN clause. I don't want you to be saddled with the OECD clauses, etc., which are present in other MFN clauses. So let's look at something with the India-Nepal treaty. Its MFN clause reads something like this. In respect of Article 12 on royalties, if under any agreement, convention, or protocol between Nepal and a third state, Nepal limits its taxation at source on royalties to a rate lower or a scope more restricted than the rate or scope provided for in this agreement on royalties. Then, as from the date on which the relevant Nepal agreement or convention or protocol enters into force, the same rate or scope as provided for in that agreement or convention or protocol on royalties shall also apply under this agreement. Now, wait a minute. I really wish I had the lungs of Shankar Mahadevan. I really wish I could read this in the same manner in which Shankar Mahadevan sang out breathless. But mind you, I actually had to pause twice to draw my breath in because this is one single sentence. What's the meaning of MFN clause? Is there a simpler way to explain it? Whenever the question arises that is there a simpler way to explain it, I use an example from my childhood. The naughty kid who you see on your left is what I used to be when I was a kid. And the lady at the center is my mom. And she used to tell me to clean my room, and I seldom ever used to do it unless I was bribed. I was bribed often with a single Cadbury chocolate, and that too, back then it used to come for I think $2. Now it probably comes for $5 or $10. I'm not too sure. And I was a happy kid. I was very happy that I was getting rewarded by one small chocolate whenever I used to clean my room. But then tragedy struck. The character that you see on the other side of the screen, the girl, is my sister. One of the most efficient persons I know. And when I learned that her reward for cleaning her room was not just one $10 small chocolate, but instead she used to get, several chocolates, and that too premium quality, Cadbury Silk, I was turning green with jealousy. I realized that sometimes mothers favor. I learned who was a favorite child. And on that day, when I had a small fight with my mom told me that, Gaurav, chill. Don't be such a drama. From now on, I will give you, as many. Okay, I'll give you 5 silk chocolates because that's the number of chocolates that I give to your sister. I said, no, hold on, wait, I don't know. Because if you start giving me 5 chocolates, how do I know for sure that you'll not start giving 10 chocolates to my sister? The problem was not just alone that I was unhappy because of my own unhappiness, but also because of the happiness of my sister, who was forever and constantly teasing me. And I said, look, mom, I think we need to settle this once and for all. We need to create a system. We need to create a mechanism through which we will ensure that whatever is the favorable treatment that my sister is getting, I'll get the same one, right? So let's agree upon that clause. My mother that day itself had figured out that I'm going to get into some kind of a tax and legal career. And that, gentlemen and ladies, is what you call an MFN clause. Now, let's read the same clause again. In respect of Article 12, royalties, if under any agreement, convention, or protocol, if under any treaty between Nepal and a third state. Just hold on a second. Which is the third state? So, which is the first and second state? First and second state are India and Nepal. So, India and Nepal already have a treaty. If a third treaty comes into existence between Nepal and any other third state in the world, right? And in that treaty, Nepal limits its taxation, its right to tax royalties. And how does it limit it? How do you limit, your right? You can limit it in either of the two manners. What are the two manners? Either Nepal agrees that it will apply a lower tax rate, or it will have a more restrictive, a narrower definition of royalty. If Nepal limits its taxation at source on royalties to a rate lower or a scope more restricted than the rate or scope provided in this agreement, India-Nepal treaty, then as from the date on which that third agreement, that other agreement comes into existence, right? The same rate or scope in that next agreement as provided in that agreement shall also apply under this agreement, India-Nepal treaty. So that is what an MFN clause seeks to achieve. If I have to represent it using a diagram, what you see in the middle is India. The first treaty is the one which India has with country X. In that treaty, India and country X have decided that whenever India will pay any dividend to a resident of country X, which is the reason why India is the source state, abbreviated as SS. And country X is the resident state, abbreviated as RS. That is where the resident, the person earning the dividend, the shareholder is resident, right? Indian dividend to resident of country X, then the right of India to withhold tax from such dividend will be restricted to the extent of 15% as against the rate given under 115A of 20%. This is the first treaty, right? In all future examples, we'll call this treaty the first treaty. But this treaty also contains an MFN clause, a most favored nation clause. And how do we use it? Now look at the other treaty, which India has with country Y. This is the third state. In this treaty, India and country Y have agreed that this dividend income will be taxed in India only at the rate of 5%. Fantastic. Therefore, when you apply an MFN clause, this beneficial lower rate of 5% gets pulled from country Y into country's X's treaty with India as well. And therefore, while India is paying dividend to a resident of country X, yet the tax rate, the maximum tax rate which India can apply to such dividend will not be the one which is written in the treaty between India and X, but actually in the treaty which is between India and Y, thanks to the MFN clause. This treaty between India and Y is what we will call in this discussion, for the limited purpose of this discussion, second treaty, plain and simple. So when we are having webinars, seminars, intelligent discussions, how can we not talk about origins? History is, after all, your favorite subject, isn't it? MFN clause, or at least some versions of MFN clauses, are found as far back as 12th century. In 17th century, this expression actually took shape. The concept is basically the same that you found in the story that I told you about me and my sister. In the story that you also listened to or heard in Three Idiots, दोस्त फेल हो जाए तो दुख होता है, बट दोस्त फर्स्ट आ जाए तो और भी दुख होता है. भगवान बुद्ध ने कहा था, लोग अपने दुख से कम दुखी हैं, औरों के खुशी से ज्यादा दुखी हैं. So the idea is, I don't want to be at an disadvantageous position. Most favored nation clause is actually a strangely named clause. A lot of time we think that the treaty which contains the most favored nation clause, that treaty says that, hey, this country will be the most favored one. But actually, no. This treaty or this clause does not mean to represent that this particular country will be the most favored of all the countries. No. It's just that it will never be disfavored in comparison to other countries. That's at least the ethos of it, right? And where do they arise from? If you look at the treaties these days, you'll find that WTO or GATS and GATT, agreements are the ones where MFN clause is the cornerstone. Imagine essentially, 200 countries trading amongst themselves, and the trade could be about goods, could be about services. And then now we have IP, intellectual property, right? And if each of them are giving differential treatment to each other, half the time, half the energy will be wasted only on trying to figure out trade routes which are most advantageous, which is a reason why WCSO is, hey, hold on, relax. From now on, every WTO member will give equal treatment to all the other members. Let me give you an example. If this country is a WTO member, and if it gives a particularly advantageous, position to one country, and mind you, that one country which is getting this advantageous condition may not even be a WTO member. Rest of the WTO members will be like, hey, you give that beneficial position to that country. I want it too. Because of the WTO, this country will have to now give the same very advantageous position to all of us, all the WTO members. And that's the whole idea about MFN clause. And this is not just for trading of goods. You'll also find in the agreements for trading of services. Now, even in TRIPS are essentially the ones which control intellectual property, again, internationally, right? Investment agreements. If you look at most of the investment agreements, you'll find that there are at least two places in the investment agreements which talk about MFN clauses. At one place, it's about actually customs duty, that if two countries are trading amongst themselves, then the customs duty tariff will be as per MFN. That is, you can't give a more beneficial tariff to somebody else. And at the other place, for the protector of investors and return on investment, right? So it says that investors from my country into your country will never be treated less favorably than the investors of your own country or countries from any other party, right? And this investment related treatment could be about management, control, operation, use, enjoyment, sale or disposal in any other manner. These are usually the 7-8 items which are listed in the investment agreements, right? There are, of course, naturally some exceptions which even WTO, right, accepts. For instance, exceptions for certain kinds of regional contracts or arrangements, or exception for developing countries. But those are just exceptions, not the norms. So if I have to present before you the spirit of MFN clause, these are the expressions I would use. A country that has been accorded MFN status may not be treated less advantageously. That's all. It may not be treated less advantageously than any other country with the MFN status by the promising country. So the expectation is not that I'm the best. It's just that you're not fooling me. You're not fooling me. That said, now we are moving back to the tax treaties, the double taxation avoidance agreements. Now, I know most of you read stuff online. You have your iPads, you have your swanky laptops. That's where you read even the treaties. So if you are in a treaty, if you're looking at a double taxation avoidance agreement, and you want to find out where the most favored nation clause is located, you'll do what? You'll press Control F and you'll write out those keywords through which the MFN clause pops up. There are 3 words which, if you write, will not take you to the MFN clause, right? First word, most. Second word, favored. Third word, nation. Most favored nation clause does not contain the word most favored or nation. You just read the India-Nepal MFN clause at the beginning, right? So where do you find the MFN clause? In 95% of the cases, you will find the MFN clause in the protocol to the treaties. Protocols are essentially those smallish documents which are appended at the end of some of the treaties, not all the treaties, but some of the treaties. The idea is that the time which it takes to finalize a treaty and then finally getting it okayed, in your internal administration between country, that also results in a bit of a lapse. Therefore, during that phase, if some newer understandings have emerged, or later on, as amendments to the treaty, then those amendments are written down in this document called the protocol. Right? And the MFN clause is found in 95% of the cases in the protocol. Having said so, it's not always the case. There are some scenarios in which the MFN clause are found in the treaty itself and not just at the end in the protocol. And I have given one scenario here, which is in the old treaty which India had with Norway till 2011-12. There, the royalty FTS clause, the one which is one of probably the most referred clause by us international tax practitioners, you'll find that in that Article 12 itself, at the end, there's a sentence which contains the same MFN expression, which says essentially that for the purpose of this paragraph, it's a part in bold on your screen, right? For the purpose of this paragraph is the one which says that, hey, source state can tax it only at a particular rate and not more. 10% is the rate which is given here. And that's what you find in 9 out of 10 treaties. But then this MFN clause adds in the same place, says that for the purpose of this paragraph, if a lower rate of Indian tax is agreed upon by any other state, than other than Norway, after the entry into force of this treaty, India-Norway treaty, then such lower rate shall be applied instead of 10%. So far we have understood about the MFN clause in its most plain vanilla form. Now I will take you through what are the variations of MFN clauses. One of the most common variations that we find in the MFN clauses is that while some treaties say that I will apply the MFN clause against a second treaty. Remember, I told you first treaty is the one which contains the MFN clause. Second treaty is the beneficial treaty which is being sought to be pulled into. First treaty between me and mom, and the second treaty between me and my mom and my sister. Right. So more often than not, you will find that the MFN clause do not say that all treaties will be the one that I will look at as second treaty. No. A lot of time what we find is OECD countries, they say that, look, I'm an OECD country and you're India, we are entering into a treaty, right? But if you enter into a subsequent treaty with another country, which is an OECD member, right, then we will look at whether that treaty is more beneficial. And if it is, then its beneficial powers will be pulled into my treaty. Probably the idea is that the OECD countries acknowledge that they are developed countries and they agree that India may give a lot of beneficial clauses to countries which are not so developed, but OECD countries will not feel necessarily jealous of them, right? And therefore will not insist that benefits given to those not so developed countries, maybe developing, maybe underdeveloped countries, should also be read into the treaty which India has with OECD member countries, right? So at least that's a logic behind it. There are some treaties which do not get into this. Our old Israel treaty, or actually treaties the same way, but since 2017, the MFN clause has been deactivated in India-Israel treaty, the Nepal treaty that we were just now looking at, Kazakhstan treaty, Philippines treaty. These are some of the treaties in which the second treaty can be with any country and not just necessarily an OECD member. So that's the first variation that we see in MFN clause. Some sets of, or most of the MFN clauses in Indian treaties, they compete only vis-a-vis treaties with other OECD member countries. Some of them, however, compete with all other treaties with any country, whether MFN or not. Second type of variation that we find in MFN clauses. In most of the MFN clauses, like the one that you just now studied, they're automatic. And by automatic, I mean that if this second treaty contains a beneficial position, a lower tax rate, or a more restrictive scope, then that lower rate or beneficial scope will automatically apply in the context of the first treaty as well, automatically, right? There are some treaties, however, which say that no, it will not be so automatic. Instead, when a second more beneficial treaty is entered into, then the more beneficial terms will not automatically apply to the first treaty. Instead, it will trigger a bilateral review of the first treaty. Basically, the parties to the first treaty, they will sit across the table and they'll say, hey, you gave a more beneficial term to that other treaty. So what are you bringing to us? We have to agree at least upon this, right? And in that negotiation, it's possible that India may be able to, or any of the two parties may be able to convince the other that, hey, there is a special scenario because of which I've given that term to that other country, whereas you don't really need it, right? So it triggers a review, it triggers a negotiation. I'll give you an example. And, India-Swiss treaty contains the example of both the scenarios. India-Swiss treaty contains a very unique MFN clause. It says that if after the first treaty is the one between India and Switzerland. If after the first treaty, India enters into a second treaty, that is with any other OECD member, in which it agrees upon a lower rate of tax, right? A lower rate of tax. Then that lower rate of tax will automatically apply to the first treaty, the India-Swiss treaty. But then it also goes on to say that if the second treaty does not give the benefit of a lower rate, instead, it gives the benefit of a restrictive scope of the definition of, say, royalty or FTS, then that restrictive scope will not automatically apply to India's treaty. No, that restrictive scope treaty will only trigger a bilateral review between India and Switzerland. So you will find both of these paragraphs consecutively again in the protocol to an India-Swiss treaty, which has undergone a lot of changes. This change actually happened because of the exchange of information related issues that India was facing with Switzerland. And this was perhaps a kind of a give and take maybe, but long story short, you find both of these variations in just one single treaty, India-Swiss treaty. There are, or in almost all the treaties, you find that the second treaty has to be the one which is entered into after the first treaty. I mean, it cannot be the one which has been entered into before the first treaty. Second treaty has to be subsequent to the first treaty, right? That's at least the general understanding of MFN clause. But some of the treaties do not contain this condition. And therefore, they simply say that if in any other treaty, India has given a particular beneficial position to a third country, then that beneficial provision will apply to the first treaty as well. And it does not say that the second treaty has to be necessarily entered into after the first treaty. Even the old treaties can, it appears, be looked into. And we will talk about actually a case law on this thing, which is interestingly a South African case law, a South African tax code case law, not even an Indian case law. Rahul has asked a question, is there any document required for applying MFN rate? Rahul, I'm coming to that. This is something on which there's a divergence of opinion between taxpayers and the revenue. And there's this another kind of variation, which we have in a sense of talking already talked about. There are most of the treaties actually give the benefit that if in the second treaty, a lower rate has been agreed to or a restrictive scope has been agreed to, then either of the two benefits will be read into the first treaty. There are some very, very limited treaties in which only one benefit is passed on but other is not. So therefore, the MFN clause may contain a language which says that if India enters into a lower rate arrangement in a second treaty, then the lower rate will apply to the first treaty as well, and then it may keep quiet. That does not say anything about restrictive scope. And the last variation is that most of the MFN clauses are about royalty income, FTS income, or passive income such as dividend interest. But there are some very limited exceptions to this rule. There are some MFN clauses in some Indian treaties which apply to income which are of different types, different nature, other than royalty, FTS, dividend interest, such as in India and Saudi Arabia treaty. There's an MFN clause in the calculation of PE profits. So generally, we know the thumb rule that the PE profits are to be computed in a particular manner, not allowing certain deductions, such as royalty paid to your own branch. But there, the Saudi Arabia treaty says that, hey, if India starts giving those deductions to somebody else, we'll need it too, right? So that's a unique flavor of Saudi Arabian treaty with India, that its MFN clause pertains to something other than royalty, FTS, interest, dividend. Similarly, India-Philippines treaty says that if for the shipping and aviation income, India exempts it, then in any other treaty, in the second treaty, then we'll also enjoy the exemption. So here, this is a very good example of the previous one, a lower rate, but not of a restrictive scope. But what are the usual benefits that we pull out of MFN clause? So I just want to tell you that in your practice, in your day-to-day life, while you have to go through all the treaties, all the clauses to the treaties, all the protocol languages, and now you have the MLI as well, in a threadbare detail, yet I would be sort of happy to share with you that on a very, very practical front, how do people usually use MFN clause to the advantage of their employers, their clients? One very common and one very natural advantage is that if there's a particular rate of tax given in the first treaty, but the second treaty contains a lower rate of tax, it is an automatic treaty, meets all the other conditions, then that instead of paying tax at a higher rate contained in the first treaty, you can happily pay tax at the lower rate, which is given in the second treaty. And the example that I'm using here is the one that you look at in the first row of this table, where the Belgian treaty says that for royalty and FTS, otherwise the tax rate is 20%. But it contains an MFN clause vis-a-vis OECD countries. Portugal is an OECD country. Now, India-Portuguese treaty says that royalty and FTS will be taxable only at the rate of 10% in the source country, India, in this case, right, in my example. Therefore, by applying the MFN clause, even if you're making a payment to a Belgium tax resident, you can still apply tax rate of only 10% and not the 20% tax rate, which is otherwise given in the Belgium treaty. Similar approach can be applied when you're, and the next one that I'm talking about is a touchy topic. In India-Netherlands treaty, there's a clause which says that dividend should be taxable at the rate of 10%, which is as it is good because, under the domestic tax law, the dividend is taxable at the rate of 20% in the hands of shareholder. But there's this, comparatively recent controversy, which we'll talk about, because of which by applying the MFN clause, which is there at the end of the India-Netherlands treaty, you can bring down your tax rate on dividend to something as low as 5%, and I want to add something on top of it as well. If you read about some of the conditions which are there in some of the treaties, for instance, a lot of treaties say that, hey, we are ready to give you a low tax rate on dividend, but not just to every minor shareholder. No, thank you. Otherwise, we'll go crazy. If there's a comparatively, bigger, substantial shareholder who holds maybe more than 10%, maybe more than 20% shares in a country, then for that shareholder, we are happy to bring out a lower tax rate, right? Some treaties say that we don't care so much about it. Just enjoy this low tax rate, right? Without bothering about whether it's a minority shareholder who's benefiting from this low tax rate or a major shareholder who's benefiting from a low tax rate. Now, if you come across a situation in which your client is an Indian company which is paying dividend to its Dutch shareholder, but the shareholder is a small shareholder, it's not a big shareholder, and you still want to apply a 5% tax rate using an MFN clause, then you'll of course have to take a detailed advice. But from FSI, India-Colombia treaty contains a 5% tax rate, and India-Colombia Treaty does not contain any such condition that we'll give that low tax rate of 5% only if there's a minimum shareholding of that shareholder. No, sire, you can go ahead and use that 5% tax rate, which is given only in fundamentally 3 treaties: Colombia, Slovenia, and Lithuania. But here you will use the Colombia Treaty. Why? Because Slovenia and Lithuania Treaty, India-Slovenia Treaty and India-Lithuania Treaty, they contain a condition that no, we'll give this 5% tax rate benefit, but the shareholder has to be a big shareholder, not a small shareholder, right? In India-Colombia Treaty, that clause is missing. Therefore, you can benefit from it. Similarly, this new creature called the multilateral instrument, MLI, it tried introducing a concept which is called dividend transfer transactions, or at least certain restrictions about dividend transfer transactions. Dividend transfer transactions are kind of treaty shopping exercise. Imagine a scenario. Forget about this MFN and all that. Right? Forget everything about it. Imagine a scenario where a company is going to declare dividends to its shareholder, and the shareholder is located in a country, the treaty of which does not give any beneficial tax rate for dividends. Right. So the shareholder will probably have to suffer a 20% tax rate. Now they might come to a conclusion that 20% is too high. Is there any treaty, with a country where one of our group countries is located maybe, and that treaty provides a lower tax rate? Just look at a corporate chart. That country. That country is the one where one of our group companies is located, and that country has a treaty with India which contains a lower tax rate. So why don't we benefit from that very clause? And they might therefore shift the present shareholding of this Indian company, which is just going to declare the dividend, to this other country. Treaty shopping, right? In that case, will the benefit of the lower tax rate be available, lower tax rate given in the treaty be available? The MLI seeks to say that, look, you guys should act more mature about it, and you should give benefit of these low tax rate only to a shareholder who has held these very shares on which dividend is being received now for at least 365 days prior to the date of declaration of dividend. Otherwise, you guys are just messing around, right? Now, whether MLI articles will be accepted by people, by countries or not, is something which is, in most of the cases left as a choice to them. But if you see here, India-Slovenia Treaty is actually something in which Article 8, this clause is applicable. Now, if, and I'm not suggesting that you go around doing it, this is just an academic discussion, right? But if you come across a situation in which you are paying dividend to a shareholder who is maybe a Dutch shareholder, but he is not an old shareholder. He has been holding the shares for less than 12 months, less than 365 days. And you still want to use the 5% beneficial tax rate. That's where you look at India-Lithuania Treaty. Why? Because in the India-Lithuania Treaty, there's no condition for those minimum 365 holding period, because Lithuania did not agree to Article 8 of the MLI, which was India. So these are, these suggestions that I'm giving to you are heavily academic discussions. Please don't think that I'm telling you that go ahead and abuse the treaties left, right, and center. But this is how MFN clauses can be explored to create tax efficiencies for your clients, for your employers, subject to, of course, seeing that you are not actually abusing them. It's not a colorable device. And now we come to the even more meatier issues, right? The controversies around it. So there are a lot of controversies which are surrounding the MFN clause. And we'll take each of those controversies one by one. Rahul, your question is still pending, and your question will be answered in the course of the next couple of controversies. Firstly, so imagine a scenario, and again, let's take the same very scenario. I'm so sorry. I just realized I missed a very, very important thing that I should have pointed out to you, right? I told you that I will tell you how you can use MFN clause to your advantage, right? I told you the advantage which comes from the first row and the third row, right? But that's the mistake which happens when you jump a row, because I missed out the second row. For all the international tax enthusiasts, you must be already perhaps aware that FTS has 2 versions. Definition of FTS has 2 versions. What I mean to say is that if you are making a payment for managerial, technical, or consultancy fees to any non-resident, then yes, that qualifies as FTS, thanks to the definition of FTS under Section 917, and thanks to a very, very similarly valid definition of FTS in most of the Indian treaties, but not all. there are several treaties which contain a narrower definition of FTS, and that narrower definition is generally referred to with the jargonish name called the Make Available Clause definition of FTS. And that's the definition which you find very often and very commonly in the treaties which India has with US, UK, and so on and so forth. In this definition, not every managerial, technical, or consultancy service fees qualifies as FTS. Only small part of that does. A large chunk of it does not. And therefore, even if you are making a payment for a technical fees, it's possible that it may not qualify as an FTS or FIS under the US-UK treaty or similarly worded treaties which contain a make available clause. And therefore, since it does not even qualify as FTS, as per the treaty provisions, that income will just not be taxable in India at all. I mean, assuming there's no PN, etc., right? Which is a very, very beneficial clause. Now, this make available clause definition is present in some of the Indian treaties, not all. But there are certain treaties which were not initially so lucky. They did not have this narrower definition of FTS, but they contained an MFN clause. So where the first treaty contains a broad definition of FTS, but an MFN clause, then what one would do is look for the second treaty, a second treaty which contains a narrower definition of FTS, and it is eligible to be pulled into the first treaty. By eligible, I mean, for example, if the MFN clause is an OECD MFN clause, then the second treaty has to be with an OECD country. By eligible, I mean, if the first MFN clause says that first treaty's MFN clause says that it is going to work only vis-a-vis a subsequent treaty, then the second treaty has to have come into existence subsequent to the first treaty. But this is also how you can benefit, that while the first treaty contains an FTS definition as per which your transaction actually does qualify as FTS and is therefore taxable in India, but if the first treaty contains an MFN clause, then you will immediately find out that is there a second treaty in existence which you can use to your advantage, because there are quite a number of them, right? That you can use to your advantage, and using that more advantageous treaty which contains a narrower definition of FTS, the make available clause definition of FTS, you will pull that benefit into the first treaty. The first treaty example, classical one at that, is the French treaty, and the make available definition example are several of them, again, India-UK treaty. And now let's assume, I'm carrying forward this example, let's assume that you have an Indian client which is making a payment to a French tax resident for an FTS kind of a transaction. Now, that transaction does qualify the broader definition of FTS, managerial technical consultancy fees, but does not qualify the narrower definition of FTS. Therefore, it does not make available technical skill, knowledge, know-how, experience, blah, 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 or does not result in development and transfer of technical plan or design to the Indian payer, right? In that case, by reading the first treaty, the French treaty, with the second treaty, the UK treaty, you can come to a conclusion that I'm making a payment to a French tax resident, yet the transaction does not qualify as FTS, and therefore I don't have to withhold tax. Wow. But here, if the stakes are really very high, it's possible that you may think that, I'm developing cold feet. I don't want to apply this principle, so very in such a straightforward manner. Why don't I take a confirmation about that from the tax authorities? Why don't I take a lower or nil withholding tax certificate? In this case, you'll urge for a nil withholding tax certificate from the tax authorities under Section 197, right? Right. And how would you apply for it? You'll apply for it under Form 15E. Now, that's where things get controversial. You get into murky waters. You think that you are applying a make available clause definition of the FTS, which is in the India-UK treaty, and you are applying India-UK treaty in the context of payment to a French resident because the France treaty has an MFN clause. So you think you are doing the exact same thing which Gaurav told you in the Taxmann webinar, life is beautiful, but life is not beautiful. In fact, there's a very fantastic case law by Indian courts, which starts with the sentence. Mind you, it starts with the sentence that life is not logic, tax is much less low. So, an interesting decision authored by Honorable Justice Badr Ahmed. If you look at Form 15E, what does it say? And I've reproduced it here. it asks you very specifically that is there a claim that you're making for make available clause? Because if yes, whether such clause in the FTS article is sought to be included in the treaty through the MFN clause. What it's saying is the make available clause in the treaty itself, in the first treaty itself, or you're pulling in the first treaty through the MFN clause? And if the answer to this question is yes, that yes, you are applying an MFN clause, then the second question is something which gives rise to controversies. The second question is that yes, if you are applying the MFN clause, then is there a notification issued by the Indian government as regards that make available clause? And that's where you stop. Notification. Gaurav didn't say anything about the notification thing. It's an automatic clause, right? Well, that's at least the position which the taxpayers take, but not necessarily the revenue. Revenue actually takes a completely different position in respect of the MFN clauses, the automatic MFN clauses. What it says is that even if there's an automatic MFN clause, unless there is a notification by us, by the CBDT, saying that yes, we are saying that the automatic MFN clause will apply, it cannot apply automatically. Which the courts have held that what are you saying? It's an automatic MFN clause. So mind you, CBDT has actually issued a notification where it has said that we are notifying the MFN clause contained in India-France Treaty, but only limited to the extent of the lower rate, but not for the purpose of restrictive scope. I repeat, what that notification has done is, if you will go through the notification, you'll find that it says that, look, India-France Treaty contains an MFN clause, and we know you guys are excited about it, right? And there are certain treaties which you can use, and it has notified. For instance, India-Germany Treaty provides a lower rate of tax. So go ahead and use that lower rate of tax even when you are applying India-France Treaty, right? But that's where it stops. It does not say that for the narrower scope of the definition of FTS using the make available clause, which is present, for instance, in the India-UK Treaty, you can read that into India-France Treaty. It does not say anything there. It's silent, and as a result of which, the revenue at least takes a position that, look, we didn't notify. We notified what we notified, and we didn't notify anything else. We did notify that you can go ahead and apply a lower rate of tax. We didn't allow you to apply the more restrictive definitions, did we? And that's where matter reached first to the Advanced Ruling Authority, and the Advanced Ruling Authority actually gave a decision in favor of the revenue in the case of Steria, but then the Honorable Delhi High Court reversed it. We have now several such other decisions in which the courts have held that nothing doing. You don't need a notification. It's automatic. So taxpayers win. Even if they're applying it, so be it. But the problem is, it's not yet settled by the Supreme Court. Therefore, you find that even now, the revenue is still holding on to the position that unless the MFN clause has been notified through a specific notification to that effect, no, you cannot automatically apply it in all the cases. Then the second controversy, and this is an even fresher controversy. And before I explain that second controversy to you, let me again remind you that when we were talking about the kinds of MFN clauses, I told you that there are, in almost all the treaties, 95% of the treaties, the MFN clause clearly says that the treaty which you are planning to apply, the second treaty which you are planning to build to the first treaty, has to be with an OECD member, right? Now, when this clause says that the treaty has to be with an OECD member, the problem arises in interpreting that when the clause says that the treaty is with an OECD member, how do you interpret this interpret this expression is, right? And that's the beauty of the tax laws. We are interpreting the word is. One possible interpretation is the one which revenue holds. Revenue says that, look, the second treaty is a valid treaty if the country with which it was entered into was already an OECD member when the second treaty was entered into. And the second interpretation says that, no, not really necessary. Even if at the time of entering into the second treaty, this other country was not an OECD member, doesn't matter. If later on it became the OECD member, chalega. Let's look at this fact pattern that you see right now on your screen. These are the facts which were in the two case laws which were before Honorable Delhi High Court. I have just abbreviated it with the name of the first case law, Concentrix. So Concentrix Dutch, the India entity, was supposed to pay dividend to Concentrix Netherlands, right? And these are the fact pattern that you see here. This is a timeline. In 1989, India-Dutch treaty came into force. In 2005, that is subsequent to it. First treaty is 1989 treaty. It contains an MFN clause. It contains an MFN clause. It says that it operates only vis-a-vis an OECD country. In 2005, India Slovenia treaty comes into force. But at that time, mind you, Slovenia was not an OECD member. Any country can become a OECD member at a later date, and that's what happened. Slovenia became an OECD member in 2010. There's no such requirement that when a country becomes an OECD member, all its past treaties have to be renegotiated, ratified. Nothing of that sort, right? Now today, dividend is being paid by concentric Dutch to concentric Netherlands, and that's where the issue arises. Because concentrics holds a position that, look, I'm making a payment under the India-Dutch treaty. I can use India-Slovenia treaty because today, India-Slovenia treaty is with an OECD member. Revenue holds an opposite position. It says that no, you cannot at all apply India-Slovenia treaty ever. Why? Because when the Slovenia treaty had been entered into by India, at that point of time, Slovenia was not an OECD member, and MFN clause is supposed to get activated only if the treaty was from the very beginning with an OECD member. Now, who's right and who's wrong? Because that's a question which went before the court, and the court said, let's interpret what is. What's the meaning of the expression is? And they said, very interestingly, right? They said, is an expression which is both autological as well as heterological. Autological means automatically explaining its logic. Heterological, the logic of which is multiple logic. It's not very, very clear. And they said that, look, we don't think what the revenue is saying is right. We think that is has to be read in a very, very plain and simple fashion. You are complicating it. The MFN clause does not say that you have to read is by going back in past, right? You have to read is as in today. And today is when the payer, in this case, concentric Dutch, the Indian entity, is saying that, hey, I want to apply the MFN clause. When it's saying that, hey, I want to deduct the tax at a reduced rate. Today is. Why are you going back in past, right? So at least that's what the Honorable Delhi High Court said, and therefore the decision went in favor of the assessee. Mind you, there are several other layers to it, and I will talk about them briefly in these slides only. But this is probably not a closed position. We can already see a lot of action by the revenue in different ways, means and ways. You can find a lot of revenue officers have written very detailed and very interesting, very well-researched articles on these matter, in which they are also trying to put a position that, hey, this is not necessarily the correct interpretation. Their logic essentially is that, look, when India entered into the treaty with the likes of Colombia, Slovenia, Lithuania, at that time, our perspective was that it's not an OECD member. And therefore, this treaty is not going to affect other treaties by virtue of the MFN clause. Later on, these countries went on to become OECD members. Does not mean that at that time our intent was to let these treaty affect other treaties. And therefore, you have to decipher what the intent of the treaty makers, treaty negotiators is. Now, at this stage, I just want to highlight a counter view as well. There are actually some treaties which use a far more clearer language. I'm not saying very, very clear language. For instance, the one which you look at here, Kazakhstan-Sweden treaty. Here, it appears to suggest in a lot more concrete manner that the second treaty has to be with a country which already is a member of OECD. But if you look at the languages which is used in the Dutch treaty, and this is something which you have to do on your own, this is a homework that I'm giving to you, right? You'll find that probably the language is not so very black and white. When coming up with this decision, the Honorable Delhi High Court actually also applied a principle which is called the principle of common interpretation. Let me first tell you what's the principle of common interpretation, and then tell you what's the controversy around it. See, the principle of common interpretation is in the context of interpretation of treaties, really. What is the purpose of having treaties, tax treaties? Tax treaties are double taxation avoidance agreement. They allocate taxing right between source state and resident state. And the idea is the allocation has to be equal, which is the reason why more often than not you find that the treaties are worded neutrally. If If one contracting state makes a payment to other contracting state, it does not say if India makes a payment to Netherlands. No, that means if an Indian tax resident is trying to benefit from this clause, will a Netherlands tax resident, a Dutch tax resident also be able to benefit from this clause? And the answer to that is yes, it should be, because if that's not the case, then the allocation of tax claim is unequal. The allocation of tax claim is unequal, then the whole very ethos, principle, spirit of entering into a tax treaty goes out of the window. The fundamental rule is tax treaties are supposed to be giving benefits which are nearly almost reciprocal. I'm consciously using the word nearly almost because there are some minute exceptions to these rules, which are as a result of negotiation. But otherwise, the idea is that a treaty has to be interpreted and applied consistently in both the contracting state, which I have abbreviated as CS, right? Both the contracting state, both the countries which are a party to that treaty. Consistent application is very important. As a result of which, if you have any doubt in the interpretation of a tax treaty, which interpretation has to be applied? And again, the answer to that, based upon the principle of common interpretation, is that interpretation which is most likely to be accepted in both the contracting state. I'm saying most likely to be accepted. I'm not saying that this is a thumb rule which will force one country to accept the position taken by another country without reviewing it at all. Instead, it means that if one country has already taken a position, probably it's a good aid for interpretation. The other country should definitely look at it. I'm not saying it is necessarily bound by it, but it should definitely look at it and guided by it. In this case, in the case of concentrics as well, what happened was, in a very, very timely providential fashion, the Dutch government actually gave a clarification. And here the Ministry of Finance of the Netherlands actually issued a clarification saying that, look, in the India-Netherlands treaty, this is a bit of a, but a bit of an interesting issue, the MFN clause and the Lithuania treaty, Slovenia treaty, Colombia treaty. If a Dutch resident tries to use it to his advantage, we'll allow it to use it. Now, this was interesting because unilaterally, Dutch government gave its position. And this position was presented before the Delhi High Court, saying that, look, Netherlands is already giving this benefit. Why should we not giving it? Because as per the principle of common interpretation, if they are upholding one interpretation, we should ideally also uphold same interpretation. It was not forced upon. It cannot be forced upon the courts, right? But, and if you read the decision, you'll find that the courts have never even suggested that they are bound by. I mean, courts are never going to feel that way, and you can't bound the courts like that anyway. Having said so, the decision of the Delhi High Court seems to be, fairly influenced by the position which was given by the Dutch government, and therefore the question arises, or at least there are certain, spheres or certain circles in which this part is getting criticized. That can the unilateral decree of Dutch government be taken into account? See, there's a reason why. What do you mean by a decree here? It's a ministry which is given this decree. By ministry, I mean, imagine in India, if the Ministry of Finance, CBDT, had issued a clarification. Would a CBDT circular be binding upon court? Of course not, right? CBDT circulars, to the extent they are benevolent, we can claim that they are in our favor, and the officers can't go against them, but they are never binding. No CBDT circular is binding upon the court, right? If the circular of our own country's ministry is not binding upon Indian courts, how can the circular, in this case, decree of the ministry of another country, be binding upon us? Absolutely not. And that was not even suggested in this decision. However, the fact that it was taken into account is being criticized by people in some circles, whereas taxpayers are of course taking a position that, look, if it's there's no reason to ignore it. After taking into account, the court applied its mind to it, and in its wisdom, it felt that it looks like a very good interpretation. We are also okay with this interpretation. So that's a bit of a controversy around the principle of common interpretation. Now I'm going to take you through a very, very interesting controversy, and this is not an Indian controversy. This is a South African controversy, but it's just waiting to blow worldwide. Look at only the first two rows starting from the first two columns starting from the left. In the middle, you see a South Africa-Dutch treaty, which was entered into 2008. In this treaty, the rate at which South Africa can withhold tax, a South African payer can withhold tax when making a payment to a Dutch resident, is 5%. It contains an MFN clause, but the MFN clause, like most of the MFN clauses, say that it will apply only vis-a-vis future treaties, not vis-a-vis past treaty, because otherwise they are already existing in a past treaty, the one which is appearing in the first column, the one between South Africa and Kuwait, which they could not renegotiate for some reasons. And therefore, the past treaty, the 2006 treaty, it contained a lesser withholding tax rate, actually a 0% withholding tax rate. It said the taxes, the dividends are exempt, but yet that treaty could not be straight away applied to South Africa Dutch treaty, because the MFN clause of the South Africa Dutch treaty, which was entered into 2008, said that it will the MFN clause will allow only a subsequent treaty to affect the South Africa Dutch treaty, but not the previous treaties. And South Africa Kuwait treaty was a previous treaty. But a wire media happened. In a roundabout, surprising manner, what happened was, and in this case is of ABC Proprietary Limited. In this case, actually, in the first year, interestingly, the payer did apply the 5% rate, but in subsequent, later on, it changed its position. It said that, look, we are relying upon a subsequent treaty. The subsequent treaty is the one which was entered into in 2012, which was between South Africa and Sweden. Now, South Africa-Sweden treaty did not contain a far more beneficial clause as regards the dividend tax rate. It also contained the 5% tax rate, but the South Africa-Sweden treaty also contained an MFN clause. And this MFN clause, interestingly, did not say in those many words that it will apply only vis-a-vis the future treaty. It said in any other treaty, which means that technically, from a literal reading, it applies even to past treaties. So while the first treaty that I was referring to, South Africa-Netherlands treaty, South Africa-Dutch treaty, it could not have been read with the past treaty of South Africa-Kuwait. The South Africa-Sweden treaty could have been read with the South Africa-Kuwait treaty, because South Africa-Sweden treaty had its own MFN clause. By virtue of this, the 0% or the exemption for dividends, which was contained in the South Africa-Kuwait treaty, could be read into South Africa-Sweden treaty. And if this South Africa-Sweden treaty, read with South Africa-Kuwait treaty, said that dividends are exempt, then this position coming out of South Africa-Sweden treaty, that dividends are exempt, could be read into South Africa-Dutch treaty. So essentially, what could not have been achieved directly has been achieved indirectly. And when the revenue said, what are you saying? The South Africa Revenue Services are, irksomely abbreviated as SARS. When they said, what the hell? I mean, that was never the intent. And actually, it's going to cost a lot of revenue to South Africa if that's going to be the interpretation. But interestingly, the tax code of South Africa said, can't help it. Because, from a literal reading, we don't think that you can force that only future treaties are to be taken as second treaties. Even past treaties can be taken as the second treaties, and if they contain a beneficial clause, they can be read into the first treaty. And therefore, this nested MFN benefit, or what some very learned authors have also used in another expression, and equally good expression, a double dip MFN benefit, was allowed by the tax code of South Africa to the taxpayers. I will now just quickly tell you one, thing which you have probably already figured out, how the MFN clause is going to affect even the application of MLI. Remember, I was telling you a little while back about how, by virtue of the multilateral instrument, dividend transfer transactions or dividend transfer rule has been introduced in several treaties. I mean, where both the contracting parties have agreed to allow this rule to be incorporated. For instance, in India-Canada treaty, right? So, dividend transfer transaction essentially requires that if a lower tax rate benefit is being given under the treaty for taxation of dividend, then that benefit will be given if and only if the said shareholder has been holding their shares for a minimum of 365 days prior to the declaration of dividend, right? Now, it means, in a sense of talking, the dividend clause gets fragmented into two parts. The first part talks about dividends which are declared to shareholders, which are less than 365 days old. And the second part is dividend rate talks about the shareholders which are more than 365 days old. Those shareholders which are more than 365 days old, they will anyway enjoy the lower rate which is given in the treaty. Those shareholders which are less than 365 days old, they will not get the benefit of this treaty. But now you have to see whether that treaty contains an MFN clause, because if it does, if this treaty contains an MFN clause, you'll say, hold on, now let me look for another treaty, a second treaty, which gives a lower tax rate benefit, irrespective of this dividend transfer rule, because that second treaty is with a country which is not a covered tax agreement. CTA basically means, or covered tax agreement means, a treaty which is also subject to MLI. Or if it is a CTA, still the one or either both of the contracting parties have not agreed to incorporate Article 8. One or either of both of the contracting parties have reserved the application of this Article 8 to their treaty, as a result of which the tax rate applicable for shareholders who have been holding shares for less than 365 days is a lower rate which is given in the second treaty, and therefore the benefit of the lower rate can be pulled into the first treaty. Now, mind you, this means circumnavigating. This means circumventing the intent, and therefore there is going to be a very high degree of challenge and litigation from the revenue on this, in my view, and therefore take it with proceed with caution on this thing. Also, don't think that everything which is written in the MLI can be overridden using MFN clause. No. There are some very limited kinds of benefits which are given by MFN clauses, and they are generally in the domain of lower rate or limited scope. But when it comes to the more fundamental issues, more philosophical issues of the application of treaties, such as the preamble text of the treaty, which now clearly says thanks to the MLI, because of the minimum standard getting activated, that look, you can't use these treaties for double non-taxation. Similarly, the principal purpose test, which is now a part of the the CTAs, that cannot be overlooked, because again, if a transaction has been entered into with the with one of the principal purposes being reduction of your tax liabilities, then again the principal purpose test cannot be overridden by MFN, because MFN only gives the benefit of reducing the tax rate or lowering the scope, but not letting the treaty applies when the treaty cannot apply because of the activation of principal purpose test. I think I see a lot of questions are here, so I'll do one thing. I will first take up the questions, and time permitting, I will take up a small case study, but the case study is such that even if we are not able to discuss it in this session, you will be able to read it, absorb it, enjoy it, and understand it fully well on your own. And if you're unable to, my contact details are, of course, at in the last slide, and you can reach out to me. So I will pause here and request Taxmann, if you wish to share the questions that have been shared with us so far, I'll be happy to take it up. Or meanwhile, till the time mail pops up in my mailbox, I will just scroll down the question that I see here from the first in, first out basis. So a lot of hellos and good evenings. Hi, everybody. Pankaj, your question, I hope, is already answered by now. What is the meaning of most favored nation, and how is the same identified in the treaty? Pankaj, the meaning is that a country will not stand at a disadvantageous position. You cannot identify it in the treaty by looking for the word most favored or nation. Look at the language. If that language says that if in another convention a benefit is given and the said benefit will be pulled into this treaty, that's what it is. Thanks, Manu. Thanks, Pankaj. Rahul has a question. Is it required to enter into a similar kind of transaction? So now, Rahul, I hope you have got the answer to this question. Revenue says yes. Something more is required. And what is it that something more is required for enjoying the MFN rate? Revenue says that notification of even an automatic MFN, much less an MFN clause which triggers renegotiation, that in that case automatically you require. But revenue says that even if you wish to enjoy a benefit which is given in the other treaty, the second treaty, by using the MFN clause in the first treaty, you cannot do that unless we notify it. Courts have consistently said that no, that's not the right of right approach. Ragini has a question. Ragini's question is: you mentioned that India-Swiss treaty, whether it's necessary that lower rate and restrictive rate both exist together in second treaty, and in case of restrictive impact, how to go ahead with applicability. Good question, Ragini. So Ragini, no, it's not necessary. See, the question is, which benefit are you planning to take? Are you planning to take the benefit of lower rate, or are you planning to take the benefit of a more restrictive scope? If you want to take the benefit of lower rate and that benefit is there in the second treaty, all power to you. Or if you want to take the benefit of the restrictive scope, then in that case, in the context of India-Swiss treaty, you can't really do a lot about it, because India-Swiss treaty says that for more restrictive scope, till the time India-Switzerland renegotiate their treaty and incorporate that more restrictive scope in this treaty, you can't automatically enjoy it, right? So you have to see which of the two benefits are you trying to enjoy. Now, interestingly, Ragini, since you asked this question, I'll always keep saying this to all tax guys, that all of our questions are so smart questions because they have traveled to courts, in some case or another. And actually, there is one decision in which the revenue tried arguing, based upon a very, very, very literal reading of the MFN clause, that the second treaty has to contain a lower rate as well as a more restrictive scope to qualify as a second treaty, which the courts promptly said nothing doing. You are reading too many dictionaries. Prashant has a question. What are the options for capital gains on equity for Singapore investors after the benefit of Singapore restricted in 2017 ended in 2019? Prashant, 2 points. Firstly, well, I wish to say that it's not really an MFN question. In a sense of talking, actually, very interestingly, Singapore treaty contained a kind of an MFN clause, and very, very restricted clause, which in a sense of talking said that, look, if India will renegotiate its stand with Mauritius on capital gain taxation, then it will have to do it with us as well. It will have to come to the negotiating table with us. But, those are things of past now. Therefore, this is not strictly an MFN question. Secondly, this is a very, very open-ended question. What are the options? Far too many thoughts in my head. And probably a lot of them are such which need discussion over a cup of coffee. That's what I'm going to charge you, but perhaps not going to be the subject contextual to the subject matter of this webinar. Avinash has a question. 197 application is an alternative pay may have to apply rather than get stuck with Form 15E. Avinash, friend, do me a favor. Would you mind redrafting a question and presenting it? Because right now, I've got two interpretations of your questions, or maybe it's just a statement, but you have a question mark at the end of it, so it's a question. So I'm not really sure if I've understood your question most perfectly. So be a dear and just redraft your question and I will take it up. Nirav has said that please share the PPT. Nirav, we will do that. Arshana has a question. Can you please show second and first slide for a second? I will keep scrolling till the time we get there, but I will also read the question asked by Mr. Guru Prasad. Could you please summarize post-MLI implications? Well, I wish there was one single way of putting it, because there are too many moving parts, Guru Prasad. What are the moving parts? Firstly, is the first treaty a covered tax agreement or not? Is the first, covered tax agreement means, a treaty which has, which is now subjected to MLI, right? And then the question is, does it contain an MFN clause or not? What's the kind of MFN clause it contains? Does it contain, for instance, a dividend kind of an article that I was giving an example about, which says that, I will give you a benefit of lower rate of dividend, which benefit has now been restricted by the MLI by applying the dividend transfer rule of Article 8. And then are you able to find out a second treaty which does not contain this rule? Because either it's not covered under MLI, or even if it is, one of the two parties have given a reservation to the same. So I wish I could give a very, very single line summary to it, but the way I would put it is, Guru Prasad, that you will have to be conscious that by virtue of the MLI, certain changes made by the MLI are such which cannot be bypassed using the MFN clause in the first treaty, right? Because those changes are far more fundamental to the issues of debts, base erosion, and profit shifting, which are sought to be addressed by the MLI. They are not something as simple as a lower rate or a restrictive scope. But in some cases, you might be able to arrive upon this interpretation that a benefit which is being taken away by the MLI is basically application of a high rate. And if that same treaty contains an MFN clause and there's a second treaty which you are able to locate, which is eligible to be treated as a second treaty, and that second treaty does not have that kind of a clause, then you are in luck. So, no, I don't think I've summarized it. But yeah, the way I would put it is read the first treaty with MLI, find out the hurdle that you're facing and whether that hurdle is something that you can overcome using an MFN or not. That's how I would probably like to summarize. And if you don't find it a very good summary, I won't disagree with you actually. Archana has a question. And meanwhile, Archana, these are the content slide is I don't think you're referring to the content slide. So verbatim reading is the first slide, and then I don't think you could be referring to this one either, right? So I'm just stopping here. I think this is the one that you're probably looking for. There's another follow-up question. Just like there are MFN clauses which are not triggered automatically, but have to be specifically agreed to between the authorities of the two states. Similarly, we have tax-paying clauses also, wherein treaty says that in case some incentive is given by source country to promote economic development, yes, then tax-paying advantage would be given to resident of resident state, actually to not resident of resident state, but yes. So in the context of tax-paying, will tax-paying advantage be given only when there is an agreement? No, I don't necessarily think so, Archana. So, a presence of a treaty is, of course, the the sine qua non. A presence of a tax-paying clause is also sine qua non. But once a tax-paying clause is contained, more often than not, you will find the tax-paying clause clearly states that this is the particular benefit that we are talking about. For instance, an ATI kind of a benefit, right? Which a country is giving, which a country is as such giving. So therefore, they should. That benefit should be given in the home country as well. So you'll find that generally it is not subject to a negotiation. There is one point that immediately pops up in my mind, so I'm just sharing it. Some tax-paying clauses actually use a very broad language. They say these kinds of tax breaks or tax holidays, and they list it out. It's section 10, a few sections are listed out, and then ATI, series, few sections are listed out. Or any such similar, tax benefits. Now, that's where the question arises that one country may feel that, hey, this is the tax benefit that we're talking about. So that should be read into the other, other country as well. But will that be so readily accepted by all the countries? It is yet to be seen. That's something to see. Quite frankly, Archana, a lot of times you don't come across the application of taxpaying because application of taxpaying clause basically presupposes that there is a double taxation scenario where a country is losing out of the tax benefit given by one state because it is still taxed on a resident basis in the source state. Because of which, if you'll ask me, I will always advise that line not to depend too heavily upon the tax-paying clause. Instead, just simply incorporate an entity in India and live happily thereafter. Sai has a question. Sai Tejesh says that where courts have upheld that there is no need to issue the notification by IT department, on what legal framework revenue authorities say again that notification for CBDT is necessary? What is the basis available to them to contradict the High Court ruling? Sai, with all due respect, and I'm sort of tiptoeing on eggshells here, we come across so many situations in which revenue authorities take a position where they say that we do not agree to what the court has said because we are in appeal against it. In my view, that's not a very respectful position to hold vis-a-vis the courts, but yet we see that happening a lot of time. So essentially the revenue authorities, you have to read it from the revenue authorities side as well. They have to keep the matter alive, because even if they at the very first step itself do not litigate this position and accept the position, then even if they win in the Supreme Court against these decisions where the High Court has so far held in favor of taxpayer, their win will not be able to salvage the loss which they may have suffered by simply applying those decisions to all the other cases. So my take on this thing is that their argument typically is that while the courts have held in favor of the taxpayer, so far this matter is still alive because the Supreme Court is still going to announce its final word. The matter has not been heard by the Supreme Court yet. Until the time it happens, the revenue authorities have to keep the matter alive, because if they won't keep the matter alive, if I file a new application today and they'll say, okay, fine, we are giving you the benefit of it, and then no assessment happens, no appeals happens, then even if they win on this matter 3 years down the line, for my case, it will not have any, it will not have any fun for the tax authorities. They would have anyway allowed me that said benefit. We still have, to our luxury, 15 minutes. And I will now take up the case study. So, I'm just reminding you, this is what we studied a little while back. And, so I had come to the beginning of the slide. For Archana, I'm going back. And since I'm not doing a screen share, but instead running it on a very specific platform, I don't have the option to click end and directly jump to the end of the slides. Here we are. Now, this is also a very, very unique situation, which I have not discussed with you so far, but you already have all the legal inputs and intelligence to figure out the situation. Let's read a case study, now. The facts are pretty straightforward, pretty linear. There's this Indian company which has taken a loan, say, from ABN AMRO, Sweden. The lender is not a government entity. It's not a government corporation, no. But the loan has been guaranteed by specific government corporation. Now, hold on. Before we proceed here, let me familiarize you with the lay of the land. A lot of time, the interest article, the article which deals with taxation of interest in treaty, a lot of time what it says is that, hey, as such, interest will be taxable in the source state, right? And at a particular rate, they give the rate 10%, 15%, whatever. But then they create an exception that if the interest is paid in respect of a loan, and the loan is given or the loan is insured, etc., by a governmental kind of a corporation or organization of the resident state, then the source state will have to let go of tax on it. Why? Let's try to understand. Imagine an organization such as Industrial Development Bank of India, right? Or Industrial Financial Corporation of India, right? These are the organizations which started, or for that matter, export promotion guarantee schemes that India has. So these are the schemes or guarantees which are governmental ones, right? And even under the local law, even under the Indian tax laws, we don't tax them. Similarly, under the Swedish law, similarly under these laws of these respective resident states, these organizations are not taxed, and therefore their incomes are sought to be kept out of tax net through the treaties as well. Therefore, while they are not taxed in their own country, under the local law of their own country, they are also exempted from tax through the treaties, because the treaties clearly say that these kinds of situations will not be taxed at all. There are other developmental or economic reasons as well to exempt these kinds of interest incomes. Sometimes these interest incomes are not even necessarily earned by these government corporations, and yet because the government corporations are a part of this transaction, these benefits are bestowed upon this interest income. So long story short, if this kind of a government corporation is in the entire lending arrangement, you will have to be cautious and you'll have to read the treaty carefully. Forgetting the MFN clause, right? You have to read the treaty carefully, that as it is it possible that the treaty contains a clause saying that in these cases, the source state, in my example, India, should not tax the interest income at all, right? Now, with this background, let's see what happened in this case. India-Sweden Treaty Article 11 is the one which deals with taxation of interest. And this article clearly contains a clause which is similar to the one that I was just now describing to you. It says, and I'm reading with you, notwithstanding the provisions of paragraph 2, interest arising in a contracting state shall be exempt from tax in that contracting state, India, provided that interest income is derived and beneficially owned by or derived in connection with a loan or credit extended by or endorsed by that particular kind of a corporation. I've taken out the name of the corporation, too long. Mark my words, it says here extended by. In my case, the one that I have given here, the loan was never extended by that corporation. It was extended by a normal banking enterprise, ABM, right? It was not endorsed by that corporation either. It was only guaranteed by that corporation, which is different from endorsement, mind you. But India-Sweden treaty contains a MFN clause, for a lot of things, including interest. And the MFN clause is pretty similarly worded to what you have already studied, that when in a second treaty, a lower rate or a narrower scope is given, then that said lower rate or narrower scope will automatically apply to India-Sweden treaty as well. That's what it says, right? Now, which is the second treaty that I want to draw your attention to? This is a treaty between India and Ireland. It contains a language which is nearly similar and not yet identical to the one that we have just now read. So Article 11.3 of India-Sweden Treaty said that we will exempt that interest income which arises from that loan, which is extended by that state government, or the government corporation. But Irish treaty uses a different language. It says that notwithstanding the provisions of paragraph 2, interest arising in a contracting state shall be exempt from tax in that contracting state, provided it is derived and beneficially owned or derived in connection with the loan or credit extended. It also uses the word extended, but then it goes on to say guaranteed or insured. Now, that is the interesting point. In the previous one, the Sweden treaty, it only talked about the loans which are extended by that particular government organization. But the Irish treaty, it says that exemption will apply not just when the loan is given by the particular corporation, but also in the situation where the loan may have been given by anybody but guaranteed or insured by this particular corporation. Now, there's this particular corporation, which in this case had actually, and this is a pretty standard feature of a lot of Scandinavian countries, mind you. So in Sweden also, there's a 95% insurance against political or war risks, which are given by these governmental institutions. And there you have how you use the MFN clause in a very creative way. So here there is an MFN clause which is not being used in a way that you see very often, and yet you see that because of this minute difference between the first treaty's language and the second treaty's language, the second treaty gives a lower rate being 0, right? In a particular scenario which is not available in the first treaty as such, but by virtue of the MFN clause can be read into the first treaty. Now, the facts that I have told you just now are the facts of a reported ruling in the case of ITR. So I will now pause here and look again if there are any other questions. Satpreet has asked a question. If some treaty, like India-Finland, requires specific MFN notification from Indian authorities for MFN notification, whether the case laws discussed can be used in that case? No, Satpreet. If the treaty does not contain an automatic MFN clause, instead it triggers a renegotiation, then without renegotiation, we should not naturally read those clauses into the first treaty. Thanks, Sai. Thanks, Rahul. And thanks, Mr. Ryan, for your kind words. We are nearly close to the allotted time for this webinar, and I will close my session here. If you have any more questions, you can reach out to me directly, or you can reach out to me through the Taxmann team, as the case may be. And for this session, the questions I've been told will be forwarded to me and my team. Either ways, you'll get your answers. But I have fat fingers, so usually I'm very bad at responding on WhatsApp. So my only request will be, please reach out to me through email. And that's not a ploy to bill you. Don't worry about it, right? Taxmann team, if there is anything that we should do at the end of this webinar, I'll be happy to. Otherwise, we can close this pretty much.
Thank you so much, sir. Thank you for this insightful presentation. I believe this information will definitely benefit our audience. We appreciate the time you took to prepare the subject matter for this webinar and precisely explain it to our audience as well. I also wish to thank the participants for being so cooperative. Thank you all for taking time out of your busy schedule and joining us in this session to make it a success. Though Sir has tried to reply all the queries raised during the session, yet in case if you have any further questions, as I said, you may please send them to us in writing at sales@taxmann.com. Thank you all once again. Have a great time ahead. Bye-bye.
Thank you. Thanks. Bye-bye.